Aaron, let me kind of jump into the markets themselves because this is not the market that I grew up in. This is probably not even the market of 10 years ago. We're seeing more and more algos, the algorithms are trading. The option market seem to be leading the stock market in some ways. Could you just take a minute to describe how different this market is from the market, maybe I got in the business with, and maybe same with you?
Yeah, I will say the stock market's pretty wild, but I also think it's a very dangerous distraction. The big surprises in 2021 are going to come from currency and fixed income markets. You
Wow.
know, keep an eye on gold, on Bitcoin, on interest rates, on Fed policy, on US government credit, state government credit, public pension plans. Those are the big news stories. Those are the big financial icebergs that can sink your ship or make you rich if you get on the right side of them in 2021. The market's pretty wild and frothy. Valuations are very high. You know, lots, millions of individual investors getting in and distorting prices far beyond what we're used to seeing in that. It's a great time to be a pro on Wall Street. The big prop trading firms, the big market makers are making 10 times as much money as they do in normal times. And to me, that says if you're not one of those people, it's a bad time to be in. As a poker player, I say it's like playing in a game with a big rake. If the casino is making 10 times as much as it usually does, chances are not very many of the players are winning.
Right. Well, let me just bring up here for the record, you're kind of dancing around something called value at risk, which you championed. And when all of the industry adopts value at risk, we know you had something there. So you mentioned outsized moves taking place, and maybe you want to kind of just jump into that because you did champion value at risk, and I want to make sure everyone knows that.
Okay. Yeah, volatility is what scares people, right? Volatility is what makes the newspaper, things go up, things go down a lot. Volatility usually doesn't kill you as an investor because it's the obvious risk.
Right.
So, if you choose you want to play around in GameStop stock or Tesla stock or even, S&P 500, you're getting a lot of volatility. Things are going up or down a lot. But the big things that matter are the things that people don't think are risky. So, when subprime came along and sank the economy, it was because years and years of housing prices going up with never going down. Everyone thought it was low volatility. So I don't, I assume anyone who's in the stock market today realizes how much volatility there is, especially if they're playing single stocks, especially frothy stocks. But I think there's a lot of things in your portfolio you might not have thought about too much that you thought were safe, you didn't have to think about. And those are the things. That's what value at risk is designed to, capture the things that may not be moving up and down a lot, but actually contain a lot of risk.
Right. But you know what? You mentioned something a minute ago. I can't let it pass. We all look at page one risk and is it this or it's that. And I let people know, hey, if it's on page one, that's really not the risk. That's probably somewhat baked into the market. But you're talking about credit risk and you threw out Bitcoin and some other things. Like what specifically would change like the back on your hairs on the back saying, wait a second, it's okay to participate. Now I actually don't want to participate. Something I see. So what early warning signal would you kind of see or feel that maybe we should pay attention to?
Well, you know those movies where somebody says it's quiet and someone says, yeah, it's too quiet.
Right.
The assassins are creeping up out of the jungle, and that's where all the birds have flown away, and you're about to get the attack.
Mhm.
Yeah, look for the things that are too quiet, that you haven't seen any stories about for a while. The stuff that's in the headlines, the stuff that everybody's talking about, is you say, yeah, it's baked in. People know about it. It's it's obvious, it's transparent. You know where the risk is coming from. It's real risk. Just don't get me wrong about that. It's stuff you have to consider, but it's the unexpected, it's the curveballs that you want to think about. And we're basically going through a major currency realignment. And I would say, I don't exaggerate here. I think it is the historic equivalent of when the world went to a central banking gold standard in the 19th century, or when the world went to fiat currencies in 1971. I think we're seeing something that's going to be just as transformative to financial markets. I don't know how it will play out, but it will affect everything. You know, if the value of money changes, everything you measure in money changes as well.
Right. And the dollar has been the store of wealth. You know, Aaron, these segments go fast. Dom and Mike are two of the principals here, and they help manage a bulk of the money. And I know they said Aaron Brown, risk managers coming on. They're always trying to look around the corner. I don't know if they have any questions for you. I would jump off by asking, is there any one or two risks that you see investors make that they need to avoid? And we get Mike and Dom in here. They may want to ask something else. Let them jump in before we run out of time.
Do people spend too much time focusing on the VIX? Is the VIX just manufactured index, or do you put any credence when the VIX starts bouncing around like it did 2 weeks ago?
Yeah, well, you probably know the VIX is a lagging indicator, right? The VIX tells you what happened last week. It isn't a very good leading indicator. So basically the VIX is high when recent volatility has been high, and the VIX is low when it's been low. When the VIX jumps up, and it's not because things have been volatile in the past, it is a warning sign, but a non-specific one. It doesn't mean the market is going to get volatile. It doesn't mean it's a bad time to invest in stocks. It means something funny is going on. So it's something to investigate and think about, but it's not a danger sign like a flashing red light.
Okay, thank you.
Aaron, if I can jump in real quick. So we're living in the age of index investing. And I don't really believe that the average investor that goes and buys the S&P 500 understands that they're actually buying all 500 stocks. And you may not want to own all 500. Not all 500 are great investments. And the index itself is forced to go out and buy stocks it may necessarily like or think are prudent, but it has to, right? Can you address the index risk that we're taking on right now?
Yeah, I'm going to give you a schizophrenic answer. Yes, those are two valid reasons to not like the index and to prefer perhaps a fundamental index or some other more stable sort of index. On the other hand, it's hard to argue with the actual performance of index funds in the past. So we know all kinds of reasons why it shouldn't work, but they do work pretty well. Anything else you do, there are a lot of things that seem smarter and might be smarter, an equally weighted index. You know, the S&P 500 is chugged around as good as anything. So I guess my big message is yes, there are better indexes and better ways to think about your portfolio and alternatives to indexing with, there are low cost, diversified, sensible ways to get into stocks other than indexing. But don't let worry about that stop you from investing at all or send you into crazy active management with high fees. Indexing works pretty well.
It sure has. It sure has for a while, and probably will continue. I think we could beat the indexes, but we need to do it carefully. We run up to time already, but Aaron, thanks so much for spending the time from San Diego. Thanks so much, the king of risk, the head of risk on Wall Street. It's a pleasure to know you. It's a pleasure to get to spend more time with you. Thanks for joining us.
Thank you very much, Jordan.
Thank you. Have a good night.
All righty. We'll take a quick break. We'll be back to wrap up the Lebenthal Report right after this.